and good day. This is the Eye of the Storm podcast with the big picture technical update for the U.S. Treasury markets. I'm going to begin with the 30-year bond future. We're going to take a look at that. And in conjunction with that, I will also be looking at the yield on that 30-year, the constant yield on the 30-year bond. But I'm going to begin here in the futures market. Currently, I am continuing to count, and let me go look at that a little bit larger picture for us. Coming here on the daily chart, actually, I'm going to go all the way. Let's go back to at least a 20-year chart. What we're in the process of continuing to count is the initial 5 waves down after making an all-time high in bond price and an all-time low in the yield or the interest rate for that 30-year bond. Now, this is the actual high, but it was kind of an anomaly when it went up there. And that bond yield is, that high was 191.22. I don't mark it there because if I go over here and I just look at that line chart, you see it takes it all away, and I have a slight higher high right there. So I went on the close basis to be more accurate in calculating. So but just I want to keep I can actually use this chart to show what actually, because it all does continue to play out. But I'll just put it back because I'm used to showing it here on the candlestick chart. So that being the all-time high for the bond price and the yield low, the rate low, 1.17. So again, on a fib basis, I would run things from here, but I think because it was such a strange anomaly and it came in so much lower, I continue to use, even for my fibs, the high that we saw in July. So based on that, we're working on our first 5 waves down off of that high. Degree truly at this point does not matter. What is a structure? So coming down to our daily chart and then trying to open this up, we've come see from there, go back up to that weekly. What we have is there is the rate 1, 2, 3, 4. We're in a 5th wave down. I'm going to count it a minor 5th because that's what I've labeled it as, a minor 5th wave down. Within that minor 5th wave are going to be 5 waves of minute degree, of which 1, 2, and 3 appear complete. Now, bringing it down to the daily chart, we can see that we had minute 1, 2, 3, and we're in the 4th wave. Within that, we had some pretty strange elongated moves as the market toiled and tried to figure out what it should be doing, where rates are going to go, what's real, what isn't real, et cetera, et cetera. There's a lot of narrative about the Fed's going to cut, the Fed's going to pause, the Fed's going to do this, Fed's going to do that, they have to, this, et cetera. We had a banking crisis going on in here, Silicon Valley Bank, Key Bank, First Republic, all going down for the count and producing massive amounts of confusion as to what interest rates were actually going to do. We picked up again at the June meeting where the Fed did pause, and that was expected, but they gave the reasons for the pause. And they also outlined that inflation continues to be a problem, and therefore we should expect at least 2 additional increases in 2023, and likely also moving forward into 2024. So that kind of ended the triangle pattern, and we started to head back down. So what it ends up being is that within that minute wave 3, we had 1, 2, 3, an elongated 4, but it does work. And then we came down in 5 waves to finish minuet wave 5 and minute wave 3. Now that puts us into a minute 4th wave. Here are the fibs. We've already reached 0.382, which actually is the most common retracement. And if we look back to say that a 4th wave usually will find its terminus, its ending point, within the price territory of the 4th wave of 1 lesser degree, well, holy cow, we're sitting right in it although our highs, if we can get up to 129, that would actually fit perfectly clean. In other words, a 4 can get up into here. What this 4 can't do is go above there. So yes, that low is 129. Well, we have 618 at 129.02. We've had stranger things happen in the bonds where it violates constantly that rule for overlapping one, or just, different things of that nature. But we have to then look at actually the cash bond and not necessarily the future. This futures market has seen incredible increases in volatility. And what I mean by that, the volatility into how quickly it's moving back and forth. Inside these moves off that daily chart, and bring it back down here, you've got big moves and slides lower, and then rally back up, and then slide lower and slide lower. And, the market just, it's actually a very difficult market to trade, but if you can catch these moves, you're going to make huge money because they're so big and they're so fast. And this is a very, very large index. Each tick is $31.25. Each point then equals $1,000. That's a lot of money. That's a big contract. And if you can handle it, you could have a lot of fun and make a lot of money. Now, so where are we? Again, I'm thinking that, and down to the hourly chart, that this is impulsive. So I'm thinking it's wave A, but my other thought, to be honest with you, got to go back out to my 4-hour chart, was that we might see another one of these, but in a minute 4 instead of the minuet 4. Possible, because we're into this period of like, well, what are we going to do? Are we going to see increase? We're going to see another pause. Are they going to, what is the Fed going to do? So that conversation is going, et cetera, et cetera, et cetera. They want to feed off of all of that. The rally in and of itself was very strong. And this just moved, and it didn't stop. It just kind of took off and it went. We had little pullbacks, but these rallies were intense. I think a lot of it was short covering. A lot of it had to do with just how positions were being put on, positions being taken off. Again, the bond market also has 0 DTE options in it. I mean, everybody has that in it. And so a lot of things come into play, and it's derivative driven. Now, what can I expect from here? I would be looking for a B wave. If this is A of 4, a B of 4. And to me, again, where the placement of wave 1, minute wave 1 is at the low is 129. Well, look how high this got in wave A, if indeed this is wave A. So is this 1, 2, 3, 4, 5 A, and this is a B, a running B maybe? And now we're back in, and we've completed it? Possible, but I don't like the count. I don't like how it's playing out. So I'm not calling that. But I don't know. Possibility. Market is going to let us know. So again, at a minimum, if we're doing a B wave, we can just put it right like that. And the B wave then, 125.18. Got the 200 sitting at 125.21, 125.18, B 382, but B waves also going to do 50 to 618. So we're looking at, from current levels, it can get as low as 124.17 again, and then turn around and do another rally. Now, would I be looking for A to equal C? I hope not, because that would push it too high. But let's see what happens. I still think we're going to see a little bit of downside here in the form of an internal B wave of that minute 4. Then we get a C wave, and then we get a stronger drop. Now, going back out to my daily, these levels correspond to the minor 5th wave. The minor 5th wave, if 5 equals, no, let me just back up 1 second, sorry. when we're comparing on a Fibonacci basis, wave 1 to wave 5, which are the most common, that's the relationship, that the first level is equality, where wave 5 would equal wave 1. Well, that, folks, is 104.11. That's what that number is. What we have outside of that is the second most common is that wave 5 will equal 0.618 of wave 1, and that is 115.25. Both levels, obviously, would put a nice ribbon around a minor fifth wave down and giving us that first 5 down, which would confirm that high and set us up for a longer term period of higher interest rates, but not before. Let me also finish this thought. Not before of what we have coming off. If it's 5 waves down, we're going to do 3 up. Bond prices move up, rates move down. So all along I've been talking about, yeah, I think we still need to get a little bit higher in rates, but that's just the setup to have a more extended period where rates will soften before we move into the next stronger period of rates going to the moon, so to speak. So that lays out there. So if we just play it according to what the Elliott patterns are beginning to tell us, then we don't have to have this argument, well, rates really should go lower, rates got to do this, rates got to do that. They don't have to do anything, but they're going to follow a pattern, and the pattern already suggests, yes, we're going to have a quick dive lower in bond price, higher in interest rates, because we got 2 more hikes coming this year alone. Whether that goes all the way through to the end of the year, and then we begin to ease up next year, it's just a picture fitting to what the Elliott wave count is already showing us. So I'm continuing to look for that type of a move. I want to see it come down in that minor fifth, finish, and then begin to do a counter trend rally. The trend remains down for right now. And even if we go into a counter trend rally, that's what we've been doing in the equity markets, folks. That's a counter trend rally. And it kicked a lot of people's butts. And actually, even as an analyst, I was like, wow, this is going much further than I thought it would. But if you take that step back and realize what the potential can be from the get-go, from that October low, it continues to show us that it had that potential to go up there. So we can do that again. Once I get that fifth wave in here in the bond market, I can run fibs to show, well, this is where the intent of this next rally, counter trend or not, what's what it's telling us, and then we'll be able to equate rates to that as well. So quick look here at that 30-year. This is just the market yield on U.S. Treasury securities at a 30-year constant maturity, right? So I need to just put this back over into my closing basis because that's really how this is reported. We don't get that intraday move. So you can see that that finish is 3.97, just below 4%. So whether we see all this huge rally in the market, in the bond market, we got that last week. Oh, it just exploded and went up. And went up 5 points. This thing closes just below 4%, which has been sitting at actually all week. So what's that show us? Well, what we have here in fifth wave, we have 0.236. We have 4.5. Actually, I can, let me go one step further, and I've got to see if I can get it's going to be quite high, but let me just see what I can put together just in terms of on a fib. If this is wave 1, and we're going to stick that all the way at the end of wave 4, we're really looking for, 4.5, 5%, where wave 5 would be equal to wave 1 at 5.5. What did I say before? 4.5, 5. Is it so unrealistic? You just got your first fib that shows you that's where it could go. And then from that level, right, we do a big corrective phase. All right, this one takes me back out. We can go back out to this monthly chart. 1, 2, 3, 4, 5. We get up to here, or even here. And now you're looking for a retracement. And that retracement is going to bring you all the way back down. Right? You can figure, you can just put that number in yourself, run it up to that 100% level, and see what it looks like coming down. Where's the 50%? Where's the 100%? No, your 50% is going to bring you all the way back down, like 2.5, 3. And yeah, people are going to go like, oh, never going to happen. They didn't think this was going to happen. So you got to trust your math. You got to trust those levels. So on the 30-year bond, again, what I am looking for, I got to go to my daily, as a quick pop. Minor 5 has the potential to get all the way up to here. And actually, I can clean this up because, in all honesty, which ones apply are these for right now. That's what applies. You above this, you add 1.618, which I've left off for right now. So yield. Back over in the bond, we're definitely looking for a pop lower. And I think if we get a decent, I mean, maybe they'll come in at a half. Not stop doing 25 basis points. Maybe they go back to 50 basis points. I don't know. We don't know. But they may decide that, oh, we got to play catch up, or we got to wrap this all up and get this done. I don't know. So we'll see. But right now, I'm looking for this wave 4 to complete. If maybe it is, I don't know. The market is going to let us know. And then we'll go from there. Let me go back out with the candle. Now, the other notes that I want to is I'm going to go look at the 5-year note. The 10 years following its own path. But here again, in the 5-year note, I got the same type of situation. Except if I was labeling this 1, 2, 3, it overlapped. 4 is way overlapping wave 1. Maybe came back down, but it puts it into a bind. So is this ABCX? And now we're doing another ABC? And we're still going to finish 4 up here somewhere? I don't know. But I changed it because I had 1, 2, 3, 4. And that's going to be interchangeable for right now. And maybe this was an anomaly. I don't know. But the 5-year note is now already presenting its challenges. And if I bring this down to the 4-hour chart and we start taking a look inside, what did that rally look like? It actually could be A, B, and a C. So if I change this to 1, 2, 3, 4, it actually came back and closed back below that, the bottom of what would be wave 1. But even this, 1, 2, 3, 4 did not overlap, and this very disturbing 5. So it could be 1, 2, 3, 4, 5, and this is actually 1, or 1, 2, 3, 4, 5, and this is actually minor. So I'm actually going to do a little bit more work on this before I actually pass what I believe could be happening in this 5-year note. I'm going to go down to the 2-year, because right now, as it is, it would need to drop very quickly. But if this changes, like I said, this is all kind of confusing as well. Let me just walk with me on this one, because I thought I had it in line before. 1, 2, 3, 4, and then we've got this elongated 5. So if I go 1, 2, 3, 4, and then we're working on the 5th wave, 1, 2, 1, 2, 1, 2. A lot of 3s. So it is a confusing picture. So I'm going to drop off on that one real quick and go over to the 2-year note. I'll work that 5 and come back to some folks on that, because here it's cleaner. We got one is right here, actually. Not sure what happened to it. It kind of drifted off and went somewhere. Let's put it back up there. So we got one right here. And then we got 2 and a 3. And then and the 4 could almost be done as well because it's dropping as quickly as it is. So we get 1, 2, bring it down to there. And then we get 1, 2, 3, 4, and that's the 5. Strange as it is. But in a 3, we get a 4, and did that 4 look good? It did. Right? A, B, 1, 2, 3, 4, 5, 4, A, B, C. And if that's the case, the 2-year note should now continue to truly come into play. And I would have to think I'm going to mark this to there, and then put this over to here to give us where this 4. This 5th could come in. 100.182 would be equality. So 2-year note does not look real healthy right now in terms of what's going to be happening. 5-year, I'm going to say, is going to have to follow suit. It's closely related just in term. And in this case, I would change this back to this and say what we've seen is that wave 4 is already done. And oops, that didn't work, did it? 3, and then a 4 up here. And come on. And then I can work out that balance. If it's going to be something different, I just don't think so. But this has been the craziness in our bond market. It's been very difficult to pinpoint because the moves are very volatile. This is like running it up and then dropping it down. One day, this is Friday. Running it up and then dropping it down a point is just pretty wild. So, in the 5-year note, then what we have is 1, 2, 3, 4. And if that's the 4, even though it overlaps, it's even, let me put it down to here, put it on that close. We still are really above it. And the only thing I can do is to change and put the 1 up here. And that's not going to, then we've got this type of a move. And you're looking for some bigger levels. You're looking for 1.618 because 100 is not going to be enough. So you'd be looking for this 1.618 or beyond in terms of a wave 5. So again, 5-year note presenting its challenges, but I can straighten that out quickly by putting the 2 here, which I think was what before, putting the 3, still 1, 2. I'm going to leave it down there for right now because this 3rd just extended. Inside of this, 1, 2, 3, 4, and this was the 5th, and it extended all the way down, which is what I did in the 30. Phew. That was live analysis here, folks. Thank you for your patience while I worked through that one real quick. But it's a 1, 2, and then the 3rd, and that's the 4. The 4 doesn't overlap, and it looks like it could be done. So we have our next decline beginning in the 5th wave as well. In the 5-year, excuse me, as well. So even if I'm going to do it where we still have another leg up in the 4th wave, I mean, this was this was incredible. We came from 105.275, right, or 315. Let me go 195, all the way up to this level, which was 108. That's a huge move to do in a week and a day, basically. This low was July 6th. This high was July 13th. Pretty amazing. So it was an incredibly strong rally in the 5-year. So I probably am going to leave it that it's done and that we're starting to drop off again. What would confirm it if we start dropping below all this and start heading much, much lower. So those actually I will remove for right now. And if we just are looking at putting it on for just a fourth wave, if we're still thinking that, or just a B wave, then we got this, and shoot. Go up here, go to there. We're looking at 107, 106, possibly 106.170, and still do another rally. Don't forget, we got the Fed. We got 10 market days, basically. 8 market days before we get the Fed decision for July. All that can happen in 8 market days. Here's 8 right here. Thursday to Friday, so it's not even. It was 1, 2, 3, 4, 5. Actually 4 market days. And we raced. So another 4 could bring it all the way down. This is where I'm going to finish it up for today. I thank you for your indulgence as I worked through that. The bottom line here is that the bond market still needs, in my opinion, bond prices need to do a quick decline, finishing that very short-term rally or counter-trend rally in the bond rate, in the rates, and then we can bring it all the way down, and we will start to see a decline, a more sustainable decline in rates and a rally in bond price.